Today's CPI report for July showed inflation rose 2.9% from a year ago. That is the lowest level since 2021. So does the report solidify a September rate cut? Well, joining us now is Claudia Sahm. She is the chief economist at New Century Advisors. She's a former Fed economist that created the Sahm rule, an indicator for the early stages of recession. Claudia, it's great to have you back on the show. I want to start right there, and that is the fact that we had an inflation report that came in basically in line with expectations, but it's still stubbornly, when you look at the core CPI, still stubbornly stuck above that 2% target for the Fed. How does this position us for an FOMC meeting in September?
Right. So the Fed has told us all year they want more good inflation data. Today was good inflation data. It wasn't great. I think Fed Governor Waller likes to give letter grades. I think he might, give this one a B+ if he's being generous. But that's what they need, is that further progress. So this checks the Fed's box on that good inflation data. But frankly, the conversation has, moved past that to some extent in terms of, can we keep waiting on more and more inflation data to really get going with the rate cuts?
It's a key point. And before I dig into that a little bit deeper with you, I do want to get your thoughts on the shelter component, because that looks like it's starting to reaccelerate or firm up a little bit more again. We know the housing situation continues to be particularly unusual. You've got high mortgage rates, high prices. Those haven't really come down in a meaningful way. So how worrisome is that?
Right. Well, it's worrisome in the sense that the Fed has been very focused on anything that might be an upside risk to inflation. Right. They want the good data. They want to be convinced and confident that inflation is going sustainably to 2%. Right. So if there's any slow poke in that movement to 2%, it's going to create potentially unevenness month to month and might look like we're backtracking and cause problems. So we had thought last month, when we saw the shelter numbers, that things had really moved down into a pre-pandemic pace, which is what we absolutely needed completely to move the needle on the CPI, because shelter is so important in CPI, but also on PCE. You're not getting back to 2% with shelter being elevated outside of some really bad, unhealthy economy situations. So last month, we've turned the corner. That risk is really, shut off, that we're going to get stuck with shelter, and it's going to take a very long time. And then we saw a pop back up this month, and it's probably some of it noise, but it does reinforce that piece of shelter, just when you look at the headline number or the core number, it's going to keep sticking it higher. But the problem is the Fed, in reacting to that, can get us in a lot of trouble, because what's pushed up the shelter inflation that we're seeing right now is a big surge in market rents that happened in 2021 and 2022. The Fed can't go back. There's no Fed funds rate that can go back and take demand out of the apartment market in 2022.
Okay.
And so there's this kind of tricky piece there.
Okay, some good context there. So the Sahm rule, it's been getting quoted far and wide, I think on a daily basis on CNBC for a number of weeks now. Very focused on labor. Two pieces to the question here for you. The first is, at a time where we're having more and more guests come on and say labor data is going to matter more now than inflation, what do you think? And just as importantly, how do you react to perhaps some of the criticism, Rick Reeder from BlackRock being the most recent example yesterday, that the Sahm rule is being taken out of context or being overhyped? Have a listen to that.
I think there's some interesting things around the unemployment rate. The Sahm rule's gotten a lot of focus, I think way too much focus. You're bringing a lot of people in the labor force. That's moved. So how do you define, what are the metrics you're thinking about?
Your thoughts?
I think we should be talking about the labor market. Not just the bad part of it, right? I think the Sahm rule, it kicked off normally when it triggers, we're in a recession, not forecasting one, we're months into one. This time, the economy does not look like it's in a recession. So, okay, so what's going on here? All right, let's have a really good discussion about, yes, there's weakening. There's some unemployment rise that's a problem. The Fed is putting downward pressure on the economy, right? So, this is not an accident that we're slowing down. So let's talk about that. And then, some of this looks like supply coming online. The labor market's actually better off than the Sahm or the unemployment rate would tell us. And it's okay, there is nothing to fear from the Fed of a strong labor market if it's strong because there's more supply. Get out of the way, right? So it actually is telling it, like really thinking hard about what's happening in the labor market. It gives messages to the Fed both on the risk to inflation, like more labor supply, you could actually be disinflationary. That's a good thing, or this risk to the other side of their mandate. And, so I think it's important that we've switched the conversation. I hear you, like, it's not a perfect metric. It wasn't supposed to turn on outside of a recession. Like, this is not, and it gets misunderstood. And some of that's, it's a simple measure. Simple measures fall apart under stress of a particularly complicated time. But this conversation is one that we absolutely should be having, and the Fed absolutely should be having too.